So this is the correction of the exercise on the integrations of relations with the rest of the world. So this is the program, the GAMS program. The structure is very similar to previous programs. Of course, there are new parameters, such as the initial value of the external sold, the world price of good I, initial exchange rate. So this is something that I didn't explain very much. This is something that I will do later on. But you've got also import tariffs on good I, and technical parameters like F, and also you've got some elasticities. Concerning the social accounting matrix, there is a new column, RM, and a new row, RM, for rest of the world. It is in French. The initials are in French. So it provides information on excess demand in each sector, that is to say exports and imports. But here I have, in fact, written only exports and imports in the row RM. So when it is negative, it is exports. So it is the case in agriculture and services. When it is positive, it is imports. So it's exactly equivalent to have 250 and 30 in column at the line agriculture and services in the column RM. You can do both presentation. It's equivalent. The intersections of RM and the RM column and the ACC for accumulation row is 150. It means that exports are not large enough to offset imports. So it means that it is external deficit of 150. Another interpretation is to say that if you consider the row ACC, you've got 1,850 of household savings. You've got a public deficit of 900. And in the column ACC, you've got investment of 200 plus 800 plus 100, so 1,100. So it means that the total demands for financing is 1,100 plus 900. So it means that the total demand for funds is 2,000 in this economy. So if you compare to household savings, it means that this economy is financed by the rest of the world. So it is also an interpretation of the external deficit of 150. Also included are new data are the amounts collected from custom import revenues, which are included in the social accounting matrix table. So here you've got initial collections of custom revenues in imports. So 0 in agriculture and 0 in services. 300 in industry, because it's only in industry that you have imports. So what is the interpretations? In fact, if you consider the social accounting matrix at the row government, you've got 150, 1,320, 280 in agriculture, industry and services. So in fact, you have custom revenues only in industry. So it means that 1,320, you have 300 of this, which is custom revenue, and the rest is indirect tax on sales of goods and services. The parameter elasticity of supply and demand of imports and exports with respect to world price. So this is an elasticity that you need to make the model run. Then you've got an entry of data of only excess demand in each sector, and also normalizations of the exchange rate, and you will see that in fact this variable exchange rate is kept constant at its initial value, because I included an exchange rate, but I wanted to neutralize this variable in order not to interfere with the other complications that I have presented in this video. Concerning the calibrations, it's very similar to the previous calibration. Care must also be taken to ensure that custom revenues, which are the sum of the amounts collected in each sector, are included in government's revenue. So you see that you've got direct taxation in the calculations of the initial value of public sold, indirect taxation, and custom revenues. Concerning, in fact, import duty, you've got calibrations which is here. It follows, in fact, what I have explained in the video. So it means that you've got a normalizations of consumption price, then a calculation of import duty following this formula. In sectors where there is exports, the import duty is 0. And then with that you can calibrate the world price. And after that you can calibrate the size parameter of the import, export, supply, demand by the rest of the world. Then, concerning the model, there are some changes. So if you look at the price block, in fact, we have two new equations. First, relations between local and world price, and then supply equations for imports from the rest of the world, which can be also a demand of exports by the rest of the world, in case ED is negative. Then you have the government block. So in the government block you have a change, because in fact in the public revenues you've got custom revenues. Concerning the market equilibrium, the goods market equilibrium, you have a new element which is minus ED in sector I on the left side member of the equation. So if it is if ED is positive, it's imports, and minus ED is negative. If ED is negative, it's exports, and minus ED is positive. Then the new macroeconomic equilibrium, you've got something which is similar to what is taught in macroeconomics textbook, because you have private savings, investments, public sold, and the external account. I have added the Léon variable on this macroeconomic equilibrium. I could have added this variable on the labor market equilibrium. And you have finally an equations which is the definitions of the external account. So take a look at the public closure. You notice that first there is the public closure. So in fact here you've got the public sold, which is constant. Another possibility is to have public budget expenses which are constant, and the public sold which varies. The second closure concerns the external closure. So here the exchange rate is kept constant, and so it means that the trade sold can vary. Another possibility is to have the trade sold constant and the exchange rate that can vary. So the shock is only an indirect taxation decrease by 10%. So if I press the run button, I am in the process window. The initial infeasibility of the first solve is close to 0. And so the second shock in 6 iteration, GAMS finds a new solution. And so you've got here the model statistics, so with 60 equations and 60 variables. So if you look at the results, you've got, in fact, the 10% decrease in indirect taxations that implies an increase in the national income of, I'm looking for this national income, it is something like 1.5%, so I do not have this growth rate in national income, so I can in fact program it by yes. So I can ask a display of this, and so I press a second run, and so you've got in fact here the results, and so the results, you show that you've got an increase in national income of 1.5%. So the explanation is that on one hand, the decline in consumer prices increases private demand, but the decline in public revenue, on the other hand, reduces public demand. And so it means that the impact on economic activity is positive, but limited. And so the impact on private demand is more important than the negative impact on public demand.